Pradiman of Cirrus Research. The latest issue of the Signals report is just out. This report is an asset allocation look at markets. It looks at stocks versus bonds. It looks at large versus small, growth versus value, risk appetites, crowding, etc. The title, The Crowding Bell Tolls in the Aftermath of a December Rally. That's right. What we've noticed in the fourth quarter was a massive pickup in the equity markets. As a result, what we are also noticing is that the leadership stocks are now hitting fairly extreme valuation levels. This is really at the core of the polarization measure, or crowding. And what this suggests is that when leadership stocks get unusually expensive, volatility tends to rise, trending factors tend to reverse. If anything, valuations begin to matter more. And so where we're at right now, this 131% premium, to put this in context, historically, this basket can trade between parity and a 60-70% premium. We're now well past that reading. So really, when we are looking at the portfolio, the idea here is that leadership may come under pressure. That could have really a sizable impact on the benchmark. When we're looking at the actual baskets, what we'll notice is that in the larger cap arena, the basket is severely overweighted in technology. We can probably put a single name to this, NVIDIA. The idea here, though, is that clustering is now getting dangerously high. And as a result, we do think that there's a real turmoil here to be seen probably in the first quarter. What is good is that the broader market does not reflect this kind of concentration. So to some degree, crowding does not really appear in the mid-smaller cap arena. Also, bear in mind, risk appetites are on the rise. Our proxy for risk-taking has begun to recover, especially in the fourth quarter, but it's nowhere near some excessive levels that would also drive a contrary view. So for now, we do have a flashing red with the crowding model, but elements such as the rest of the market not being crowded is important. Risk appetites are not excessive, and that's a very constructive thing. And then finally, when we bring this all together, the asset allocation model is still overweight equities. That's really important here. I think what's driving this, as much as we may have pockets of excess, is the bottom line is that the fundamentals are fairly firm. Earnings are stabilizing, credit markets are fairly easy, and the threat of inflation has actually really leveled off a bit. So take a look. With any questions, feel free to give me a call. Thank you.